The Fed delivered its fourth straight rate hold in an expected decision yesterday, and the median dot plot projection continued to show policymakers expecting 2 rate cuts this year. But there were increasing signs of a split, with 7 officials expecting rates to stay on hold for the rest of the year. That's up from 4 when projections were last offered in the month of March. In updated economic forecasts, policymakers downgraded their outlook for growth this year and signaled they now expect inflation of 3%, up from the 2.7% projected in March. And those projections raised concerns around possible stagflation, with Chair Jerome Powell warning that tariffs will hit the outlook for inflation and have stopped the Fed from cutting rates.
What we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs. Ultimately, the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
All right, let's dissect all of this with Paul Donovan, Chief Economist at UBS Global Wealth Management. Paul, always great to have you in the studio. So what do you make of what the Fed offered to us? Because initially the market saw it as a dovish sign, and then it flipped. Now it was sort of a hawkish takeaway. What's your message? What's your takeaway?
Well, I think the flip-flop in the markets is exactly the right reaction, that this is a Fed that doesn't know what it's going to be doing. We have uncertainty. To quote President Trump in a different context, I mean, nobody knows what I'm going to do. And that is the Fed's fundamental dilemma. They don't know what the tariffs are going to be. They don't know what the reaction of inflation and growth to those tariffs is going to be. They don't know what the reaction of businesses and consumers is going to be. And so in that situation, as Powell pointed out, there is very low conviction about any individual forecast for the future because there's such a wide range of risks around it. So I think that the uncertainty that the market was displaying yesterday with how do we interpret this, it's probably the right response. It is an uncertain policy environment.
Because the dot plot continues to signal that there are going to be 2 cuts, even though fewer members are seeing, or an increasing number of members are seeing fewer cuts this year. Had they changed the dot plot, suggesting a different number, fewer cuts, that would have actually told the market, hey, we kind of know what the forecast is, we know what's going to happen, but they really don't. Better be safe than sorry and just leave it unchanged?
So the curse of the dot plots. I think every Fed official or former Fed official I speak to says that we should never have published these things.
Okay, that's good to know.
The issue here, of course, is that with the dot plots, you don't have any sense of probability. So somebody who was saying, right, I'm 55% for 2 cuts and now I'm 45% for 2 cuts, that's not being reflected because it's not subtle enough to do that. I think what is interesting with the dot plots is that you're still seeing a majority looking for 2 rate cuts, even though inflation has been moved up in terms of the central forecast. So people are saying, yeah, look, we're going to see more inflation, but we're still going to stick with rate cuts. And that, I think, is sort of the dovish spin on this situation, is that even with expectations of higher inflation than was previously the case, people are still saying, yeah, we've got to look through that and keep cutting.
And that's the great thing about this FOMC meeting yesterday. There was something in it for everyone, the doves and the hawks, of course. So where does all of this, Paul, leave the U.S. economy? Because we got the retail sales, and they were ugly. How does the consumer feel?
So partly that depends on who you vote for. Because if you look at the sentiment surveys, and I am not a fan of sentiment surveys at all, ever, but if you look at the sentiment surveys, registered Democrats are saying it's the end of everything, and registered Republicans are saying all is for the best in this best of all possible worlds. And actually we've seen that coming through in some of the retail sales numbers. So blue-leaning states, you saw buy in advance before the tariffs hit. Red-leaning states, you've not seen that. So consumer reaction is actually being shaped by political polarization. At the end of the day, the sequence is this. Tariffs raise inflation. Inflation means lower spending power. Lower spending power hits the consumer. You see weaker consumer spending, maybe a weaker labour market, then slower economic growth. But that is a process that plays out not over the next couple of months, but over 9 months in total. So the inflation hit is going to be probably July, and then we will start to see the consumer reacting over the summer, and then we will see the longer-term implications towards the end of the year.
And the Fed, in its model, it has already factored in, I think, a 10% increase in oil prices, but you seem to think that they're not going to stay at these elevated levels.
I would be surprised, to be honest. I mean, we have obviously a very serious situation in the Middle East, huge humanitarian consequences. The economic consequences are still relatively slight. Now, that could change. But at the moment, we're not actually seeing significant disruption to global oil supplies. We're not seeing significant disruption to global shipping lanes. That's a more minor consideration. Unless we see longer-term changes to the risks there, I am not inclined to suggest that this is going to be an additional level. And I think we go back to considering what's happening with global growth and trends in terms of demand.
Now,